Investment flash.
China just cracked the AI hardware trade, buddy. NVIDIA credit protection costs went through the roof, and the entire chip supply chain is getting gut punched. We're talking ASML, Applied Materials, Lam Research, all in the red. The picks and shovels trade, breaking down. We'll break it all down on Investment Flash.
Good morning. It's Wednesday, July 29th, the London edition. I'm Marie with Tom and Gerald. China's lithography claim is shaking the entire AI hardware thesis, and the rotation into defensives and crypto is on. Let's get into it.
All right, first up, the AI hardware route. NVIDIA's credit default swaps surged by a record amount. That's the cost to insure against default. And we saw reports China can now make their own DUV lithography machines. That's the gear that prints advanced chips. And Gerald, remember yesterday we said sell NVIDIA? Yeah, that call is aging like fine wine.
Tom, yesterday you wanted to sell everything with a chip in it. But a single report on Chinese DUV capability, and we're acting like ASML's moat is gone? ASML still owns extreme ultraviolet lithography. That's the cutting-edge stuff. This DUV news is maybe a 3-year-old story, honestly.
No, but Gerald, the point isn't that ASML's monopoly is over tomorrow. It's that the monopoly rents are under threat. If China can make even mid-range chips domestically, that's less demand for Western equipment. The market is pricing in a structural shift, not an overnight collapse.
Exactly. Applied Materials down almost 8% last session. Lam Research down 7.5%. The semiconductor ETF down over 3%. And it's not just the China threat. NVIDIA's credit costs surging tells you there's stress in financing these AI buildouts. The cost of capital is rising right when the moat is narrowing. Bad combo.
Fair enough on the margins, but NVIDIA's credit move, it's record-setting, but it's off very low levels. This is hedging, not a default signal. And the semiconductor ETF is already 21% below its 52-week high. How much more pain is priced in?
Look, I'm not calling for Armageddon, but the picks and shovels trade was built on infinite demand and zero competition. China's move introduces competition. And speaking of financing costs, the Wall Street Journal has a piece on Meta. Meta just priced a $12.5 billion data center debt deal at a higher rate than last year. AI CapEx is getting more expensive to fund.
Right? That's the double whammy. Higher borrowing costs for the very companies that are supposed to be buying these chips. If Meta is paying more, so will others. Margins get squeezed, CapEx gets trimmed, chip orders slow. It's a chain reaction.
All right, but Meta's stock is already down nearly 9% year to date, 26% off its high. The market's been pricing this in for a while. The question is whether earnings can offset the higher costs, and we haven't seen the full earnings picture yet.
And that's exactly the risk, Gerald. If earnings disappoint, the whole AI CapEx thesis unravels. We're not saying sell the farm, but we are saying the headwinds are real, and the rotation trade has legs.
Exactly.
See, this is what I mean. The financing angle is just as scary as the China threat.
Analysts downgrading after a 10% drop. That's not analysis, it's a weather report.
Fair enough.
Yeah. All right, but the China story isn't going away.
Speaking of not going away, crypto is one of the few bright spots. Morgan Stanley just launched Ether and Solana exchange-traded products after their Bitcoin fund hit $381 million in assets. Tom,
crypto. Buddy, Ether and Solana are risk assets. If the Nasdaq sneezes, crypto catches a cold. But I'll give you this. The ETP launches are a smart play by Morgan Stanley. They're tapping into demand while it's hot.
Hold on, I'm going to push back here. The institutional angle isn't just hot money. These products make it easier for RIAs and pension funds to allocate. That's sticky capital. And Solana in particular is gaining traction as a platform for tokenized real-world assets. That's a fundamental story, not just ETF flows.
Right. Sticky capital. That's the exact phrase, Marie.
To be fair, the ETP structure does make it easier for institutions to get exposure without custody headaches.
And Solana's real-world asset tokenization is a genuine innovation. It's not just a meme coin.
Bitcoin is sitting near 68,500. That's critical resistance. Break higher and we could see serious momentum despite the Nasdaq futures being under pressure. Crypto's divorcing from tech, maybe.
A decoupling narrative? I'm skeptical. The correlation has been tight all year.
But there is evidence that institutional flows operate on a different time horizon. It's not all speculative retail.
All right, let's move to energy and metals. Gerald, the FT has a piece on China's grip on electrification metals, rare earths, and lithium. Take it away.
Yeah, the FT warns that China's dominance could stoke inflation and delay the green transition. The rare earths ETF is down 10% year to date, 41% off its high. That's a value play if supply gets tight. And lithium, same story. Electrification isn't slowing, but the supply chain is concentrated.
Only Gerald could turn a supply chain crisis into a value play. But honestly, he's not wrong.
And the green transition depends on these metals. If China restricts supply, prices could spike. It's a strategic risk that isn't fully priced in.
And then there's oil, stuck in what the FT calls a bad equilibrium. Directionless, volatile. Oil's in a bad equilibrium. Sounds like my dating life.
Tom, I'm not touching that.
All right, moving on. Unilever's blowout quarter. World Cup marketing blitz drove the best volume growth in 16 years. Defensive staples delivering.
Unilever up almost 9% last session. That's a monster move for consumer staple stock. And meanwhile, luxury is bifurcating. The FT's bags or baubles piece is our most original take. Marie, you want to frame this?
Yes. The idea is that AI wealth is concentrating at the very top, creating a K-shaped economy, so hard luxury, think Richemont's Cartier jewelry and watches, benefits more than soft luxury, like LVMH's Louis Vuitton handbags. It's a trickle-up effect. If we're in an AI-driven wealth boom, the ultra-rich buy baubles, not bags.
Cartier over Louis Vuitton. That's the trade. Simple as that.
But Richemont at all-time highs. How much juice left? LVMH is down year to date, but it's a diversified conglomerate. Is this just a relative value play, or is there a structural shift in luxury consumption?
The trend is your friend, Gerald. AI wealth is creating more centimillionaires, and they're not buying the same stuff as aspirational consumers. The hard luxury houses have higher margins and pricing power. It's a clean thesis.
All right, macro risk on call. HSBC strategist says stay long equities because earnings are strong and valuations are undemanding. Contrarian amid a tech sell-off.
I'm suspicious of a call to buy at highs. But to be fair, the S&P 500 is still near records, while the Nasdaq 100 is down. If you believe the rotation continues, you want broad large caps, not tech-heavy.
But earnings are strong and valuations are undemanding. HSBC saying stay long is like a baker saying eat more bread. It's their business, but it doesn't mean the bread is bad.
I'll take that analogy. And the rotation is into broad indices, not out of equities. That's the nuance.
All right, then there's the AT1 bond alarm. Man Group says investors in those risky bank bonds are far too complacent, spreads too tight. If that blows up, it could hit high-yield credit and regional bank stocks.
But bank debt spreads are tight for a reason. The economy is doing fine. Default rates are low. Are we just fear-mongering?
Hold on. Regional banks are near highs. If credit spreads widen, they'll get hit. The regional bank ETF is up over 15% year to date. That's vulnerable to a credit shock.
Exactly. And the high-yield ETF is near 52-week lows. If credit reprices, that could break lower. It's a tail risk, but it's real.
Fair point. All right, quick hit. CXMT's blockbuster IPO delivered 5,000% gains for Hefei government funds. Gerald, Your kind of story?
A windfall for the local government, but for foreign investors, not so much. The China large cap ETF is cheap, but geopolitical risk keeps me away. It's a great headline, not a trade.
And the minor pivot, Core Scientific signing an AMD AI deal, winding down Bitcoin mining. Tom, you're up.
I love this story. Core Scientific down 32% from its high, but this pivot could be a lifeline. And AMD winning the chip supply deal is a positive, even though the stock got hammered last session. It's a dip opportunity if the AI narrative holds.
Tom, you're betting on a turnaround story while also shorting semiconductors. That's a bit schizophrenic, buddy. If AI capex slows, Core Scientific's new business model takes a hit too.
All right, let's bring it home. Our view is rotation. The cleanest expression is a pair trade. Long Ether via the new Morgan Stanley ETP and short the semiconductor ETF. Crypto gets institutional tailwinds, while semiconductors face structural headwinds.
That's it. Crypto tailwinds, chip headwinds. It's a bet that the rotation continues.
But the bear case, the China DUV news might be overblown. If ASML's high-end EUV remains unchallenged and Nvidia's earnings blow the doors off next month, the whole AI hardware trade could rip higher and the rotation gets stopped out. This pair trade would get crushed.
That's the risk. And the Fed could turn dovish on Wednesday, sparking a broad rally. But for now, the momentum is with the rotation. As always, none of this is investment advice.
If you're just finding us, hit follow on Spotify or check investmentflash.com for the full digest with charts and sources. We're back at 9 a.m. New York time for the New York edition. See you then.